Most traders don't fail because they don't know enough. They fail because they're listening to the wrong clock. The screens refresh, candles print, decisions feel urgent, and slowly, without noticing, the market trains you to confuse motion with progress. At the time, it feels logical. More data should mean more control. More signals should mean better timing. Shorter time frames should mean faster feedback. It rarely works that way. Most people don't notice this until it's too late. There was a trader who learned this the hard way, not in a single blow-up, not in a dramatic collapse, but through a slow erosion of confidence that felt, at first, like normal trading. This is where the story begins. This is timeless market lessons, where market wisdom outlives markets. The uncomfortable truth is that intraday trading doesn't usually fail loudly. It fails quietly. The account doesn't vanish overnight. It just stops growing. Then it slips. Then it recovers a little. Then it slips again. And somewhere in that cycle, the trader starts blaming execution, or psychology, or news flow, rarely the time frame itself. Here's a question worth sitting with. What if the problem wasn't discipline? What if it was proximity? Lower time frames pull you closer to noise, and noise has a personality. It feels actionable. It feels important. It feels like information. But most of it isn't. It's friction. It grinds attention down into smaller and smaller decisions until every trade feels personal. Pause for a moment. Imagine making 10 decisions before noon, then 20, then 30. Each one carries a small emotional charge, not enough to feel dramatic, just enough to matter. By the end of the day, you're tired, not physically, cognitively. And tired traders don't notice patterns. They react to interruptions. This trader started exactly there. Intraday charts, 5-minute entries, 1-minute exits. Everything tight, everything precise. On paper, it looked professional. In practice, it was exhausting. The market rewarded him just enough to keep him engaged. Small wins, occasional streaks, losses explained away as bad luck. He wasn't reckless. He wasn't ignorant. He was simply too close. There's a statistic most people don't talk about. The majority of discretionary intraday traders underperform, not because they're wrong on direction, but because their error rate compounds faster than their edge. Small mistakes stack, fees stack, emotional resets stack. This is where traders usually get it wrong. They try to optimize inside a broken frame. He did what most do. Adjusted indicators, changed position sizing, tried different sessions. Nothing changed. The stress stayed constant. The account stayed fragile. Then something broke. Not the account, the story he was telling himself. He realized he was spending more time managing reactions than managing risk. The charts dictated his mood. A single candle could erase an hour of confidence. Waiting felt painful because waiting meant watching. That's the key most people miss. Waiting is only painful when you're too close to the outcome. At this point, many traders quit. He didn't. He stepped back. Literally, he zoomed out. This is where Mark Minervini's influence enters the picture, not as a strategy, but as a framework. The idea that time frame is not just a technical choice, it's a psychological boundary. Minervini understood something many overlook. The daily chart removes negotiation. It doesn't ask for constant input. It doesn't reward impatience. It forces selectivity. That realization didn't feel freeing at first. It felt like loss. Fewer trades, longer waits, less activity. For someone wired to act, it felt like giving up control. Silence carries weight here. The first week on daily charts felt empty. No early morning urgency, No midday scramble, just levels, just structure, and a lot of time. Here's the irony. The same trader who couldn't wait 10 minutes on a 1-minute chart could suddenly wait days, not because he became more disciplined, but because the chart stopped provoking him. Perspective shift. The daily time frame doesn't shout, it doesn't tempt, it doesn't reward twitch reactions. It simply presents facts. Price closed here. Volume behaved like this. Trend is intact, or it isn't. Notice what disappears: micro decisions, constant validation, the need to be right now. Another question to consider: what if patience isn't a personality trait? What if it's an environment choice? By stepping away from lower time frames, he wasn't slowing down his trading, he was slowing down his thinking, and that changed everything. Losses became smaller because entries were cleaner, not perfect, cleaner. Wins lasted longer because there was no reason to exit early. The account stopped swinging emotionally because the chart stopped demanding attention. This didn't feel exciting, it felt stable. Stability is underrated in trading because it doesn't stimulate dopamine, but it compounds quietly. Most people chase setups. Professionals protect clarity. There's a difference between being informed and being involved. Intraday charts force involvement. Daily charts allow observation. Observation leads to better decisions because it creates space between stimulus and response. That space is where edge lives. If this resonates, subscribe. We explore these patterns weekly. The identity threat here is subtle. If you've built your self-image around being fast, adaptive, always on, stepping back feels like regression. It isn't, it's alignment. This trader didn't become passive, he became selective. Fewer trades, higher standards, less noise, more consistency. And perhaps most importantly, waiting stopped feeling like punishment. It became part of the process, a feature, not a flaw. The pattern repeats, always. When traders fail, they rarely ask if the time frame itself is shaping their behavior. They assume the problem is internal: willpower, focus, confidence. Sometimes it's none of those things. Sometimes the chart is simply too close. The shift didn't solve everything. It exposed something quieter. Once the noise faded, the inner conflict became impossible to ignore. On lower time frames, discomfort is masked by activity. There's always another candle forming, another decision waiting, another chance to fix the last one. Daily charts remove that escape. You make a choice, then you sit with it. This is where most traders feel the real pressure. Because now the enemy isn't volatility. It's yourself. He noticed it in small ways, checking prices more often than necessary, imagining outcomes before they happened, feeling relief when a trade moved in his favor, then irritation when it stalled. Nothing dramatic, just a constant low-level hum of anticipation. This is the psychological cost few talk about. Waiting without interference forces you to confront uncertainty directly. On intraday charts, uncertainty is fragmented. It comes in short bursts. On daily charts, it stretches, it lingers, and that makes traders uncomfortable. Here's a pattern most people miss. The human brain is bad at open loops. When a position is on and nothing is happening, the mind fills the gap. It looks for threats. It invents reasons to act, not because action is required, but because tension wants release. Are you making this mistake? He realized that many of his past exits weren't driven by information, they were driven by relief-seeking. Closing a trade ended the discomfort. It also ended the edge. This is where traders usually get it wrong. They believe patience means suppressing emotion, white-knuckling through boredom, fighting the urge to act. That's not patience, that's resistance. And resistance eventually breaks. True patience feels different. It feels neutral, almost indifferent. But neutrality only appears when the decision framework is solid enough to carry the weight of uncertainty. At this stage, he wasn't there yet. The daily chart gave him space, but it also removed excuses. Losses couldn't be blamed on speed. Wins couldn't be credited to reflexes. Everything traced back to preparation and selection. That accountability stung. There's a quiet statistic worth noting. Traders who operate on higher time frames make fewer decisions, but each decision carries more weight. That weight forces clarity. You can't hide sloppy thinking behind frequency. This is the moment where many revert. They drop back to lower time frames, telling themselves they just need more experience, more screen time, more reps. What they really want is relief. He stayed. Not because it felt good, because it felt honest. Over time, a realization formed, slowly, without fanfare. The problem was never waiting. The problem was deciding too early. On intraday charts, decisions are provisional. You're constantly renegotiating. On daily charts, decisions are deliberate. You define conditions in advance, then let price confirm or invalidate them. This is the core shift. Decision-making moved upstream. Instead of reacting to price, he started defining scenarios. If this level holds, I stay. If it breaks, I'm out. No debate, no reinterpretation mid-trade. This is where Mark Minervini's framework becomes relevant again. Not the setups themselves, but the emphasis on decisiveness paired with restraint. Tight risk, clear invalidation, no emotional bargaining. Minervini's approach assumes something important, that the hardest work happens before the trade, not during it. Once that clicked, the waiting changed character. It wasn't empty time anymore. It was execution of a prior decision. Perspective shift. When the outcome is already defined, watching price unfold loses its emotional charge. You're not hoping, you're observing. This is the realization most traders never reach because they're too busy managing feelings in real time. He noticed practical changes. Mornings became quieter. He reviewed levels once, placed alerts, walked away. The market no longer dictated his schedule. It informed it. Losses still happened, but they felt contained, almost expected. Wins felt less euphoric, which was a good thing. Emotional symmetry returned. Here's the uncomfortable part. The edge didn't improve dramatically. The experience did. Consistency came not from being right more often, but from being wrong the same way each time. Defined, limited, repeatable. This is what a decision framework actually does. It standardizes behavior under uncertainty. It removes improvisation from moments where emotion is highest. Most people think trading skill is about better prediction. It isn't. It's about better containment. Daily charts didn't make him smarter. They made him slower to react and faster to decide. That distinction matters. If this sounds familiar, the channel is built for listeners like you. Consider subscribing. By the end of this phase, something subtle but permanent had changed. He no longer felt the urge to prove himself to the market. There was nothing to chase, nothing to fix in real time. The market became a place to express a process, not a test of an identity. And once that happens, impatience loses its grip. The application of this shift didn't arrive as a dramatic overhaul. It showed up in ordinary mornings. He stopped opening charts immediately, not out of discipline, out of necessity. The decisions had already been made the night before. Levels marked, risk defined, scenarios written down in plain language. If price does this, I act. If it doesn't, I don't. That simplicity changed the rhythm of the day. Morning became preparation, not anticipation. A brief scan of the daily charts. No searching, no scrolling, just confirmation. Alerts replaced constant watching. Execution moved from reactive to conditional. This is the practical difference between amateurs and professionals, and it's quieter than people expect. Amateurs trade the screen. Professionals trade their plan. With daily charts, execution compresses into small windows, a few minutes of action, long stretches of nothing. That nothing is where lifestyle quietly improves. Stress levels dropped, not to zero, just below the threshold where it leaked into everything else. Sleep improved because positions weren't constantly in flux. Relationships benefited because attention wasn't fragmented every 5 minutes. This isn't talked about enough. Trading style bleeds into life. High-frequency decision-making trains the nervous system to stay alert, even when markets are closed. Slower frameworks allow the body to downshift. Another perspective shift. When trades last longer, you stop needing constant affirmation. The market no longer interrupts meals, conversations, rest. That space restores judgment. He also noticed something uncomfortable. Many days passed without trades. At first, that felt unproductive. Then, it felt correct. Here's the consequence most people ignore. When you force activity, you manufacture risk. When you allow inactivity, risk becomes selective. Losses now came from clearly defined invalidations, not impulsive exits. Wins came from alignment, not luck. The equity curve smoothed, not dramatically, reliably. There's a cost to ignoring this lesson. It doesn't show up as a single failure. It shows up as burnout, as chronic second-guessing, as a sense that trading is always demanding something back. He had lived that version. This one was different. Daily execution became boring, which is exactly what it needed to be. Pause here. Boring doesn't mean easy. It means repeatable. Over months, the process evolved. Rules were refined. Fewer instruments made the cut. He kept records not of profits, but of behavior, where he hesitated, where he interfered, where he followed through. Learning shifted from consuming information to auditing decisions. That's pillar 6 in practice, even if he never named it that way. Adaptation didn't mean changing strategies often. It meant making small, infrequent adjustments backed by evidence, removing what didn't matter, protecting what did. There's a reason experienced traders reread the same ideas instead of chasing new ones. Depth beats novelty when pressure is involved. At this stage, Mark Minervini's name came up less in thought and more in principle. The emphasis on waiting for alignment, on letting price prove itself, on risking little when wrong and pressing only when conditions are clear. Not as a rule book, as a filter. The lifestyle impact became the final confirmation. Trading stopped feeling like a performance. It became part of a larger structure. Health mattered again. Time away from screens felt restorative instead of risky. Identity loosened. That last part is subtle but important. When your self-worth isn't tied to every trade, patience stops being a struggle. It becomes a byproduct. This is the resolution most people expect to feel triumphant. It isn't. There's no clean ending, no final confidence that never wavers, just a steadier relationship with uncertainty. He still had losing weeks, still questioned decisions occasionally. The difference was proportion. Trading no longer dominated his inner life. The market remained unpredictable. His behavior didn't. And that's where the story rests, not on daily charts as a magic fix, but on distance as a form of control. The farther you stand from noise, the easier it is to hear what matters.